Welcome to The Explainer. Today, we're going to dive into what might just be the single most important book on investing ever written, Benjamin Graham's masterpiece, The Intelligent Investor. Seriously, this isn't just a book, it's a whole philosophy that has built the fortunes of some of the world's greatest investors. I mean, you don't have to take my word for it. Just look at this endorsement. That's from Warren Buffett, Graham's most famous student. He literally said this book gave him the entire intellectual framework for his career. Get this, he said Graham's influence was second only to his own father. That's the kind of legacy we're talking about here. So what's the big revolutionary idea? Well, it all boils down to this one core concept: value investing. And the key is a massive shift in how you think. You're not just buying a ticker symbol that bounces around on a screen. No, you are buying a small piece of an actual real-life business. And you should treat it like any smart shopper would. You only buy it when it's on sale, for less than what it's really worth. Okay, before you can even think about using his strategies, Graham makes you answer a really fundamental question about yourself. Are you an investor or are you a speculator? Because in his world, that distinction isn't just a word choice. It's everything. And this breaks it down perfectly. On one side, you have the investor. They analyze the business, they focus on keeping their money safe, and they aim for a solid, sustainable return. Then on the other side, you've got the speculator. They're just betting on which way the price will wiggle next. For them, the market is a casino. And honestly, the person who usually gets rich in that game is their broker, not them. To make it crystal clear, Graham gives us this incredibly simple, powerful test. Any financial move you make has to check all three of these boxes to be called an investment. If it misses even one, let's say you didn't do the homework or your initial capital is at huge risk, then by his definition, it's speculation. Plain and simple. Okay, so once you've sorted out that you're an investor, Graham introduces his most brilliant and famous analogy. It's this fantastic mental tool that helps you deal with the absolute psychological chaos of the market. So I want you to picture this. You co-own a business, and you have just one partner. Let's call him Mr. Market. Every single day, without fail, Mr. Market comes to you and offers to either buy your share of the business or sell you his. But here's the catch with Mr. Market. He's wildly emotional. Some days he's totally euphoric. He's convinced your business is the best thing ever, and he'll offer to buy you out at a ridiculously high price. But then, on other days, he shows up and he's a total wreck. He's panicked, he's pessimistic, and he's absolutely certain that your business is about to go down in flames. On those days, he's desperately trying to sell you his stake for just a tiny fraction of what it's worth. So how do you deal with a partner like this? Simple. The intelligent investor knows that Mr. Market is there to serve you, not to guide you. When he's panicking and selling cheap, you happily buy from him. When he's ecstatic and offering you a fortune, you might consider selling to him. And if you don't like the price he's offering that day, you just ignore him and get on with your life. His mood swings are an opportunity, not your marching orders. And this idea, buying from a pessimistic Mr. Market, leads us right to the single most important principle in the entire book. It's called the margin of safety. And this is your golden rule. This is what protects you. Put simply, the margin of safety is just the gap between what a business is actually worth, its intrinsic value, and the lower price you pay for it. Think of it as your financial cushion. It's the buffer that protects you if you made a mistake in your calculations or if the market just goes crazy for a while. And this visualizes it perfectly. Let's say you do your homework and figure out a company is really worth $100 per share. But Mr. Market, in one of his depressive slumps, is offering to sell it to you for just $60. That $40 gap? That is your margin of safety. It's the cushion that protects you from bad luck, from your own miscalculations, and just from the simple fact that the future is uncertain. So when you put all these big ideas together, thinking like a business owner, using Mr. Market's mood swings to your advantage, and always demanding a margin of safety, you fundamentally change the game. You stop being a passenger tossed around by the market, and you become the pilot of your own financial future. But Graham leaves us with this final, profound warning. He says that being a successful investor isn't really about having a sky-high IQ. It's about having the emotional discipline to stop yourself from doing dumb things. The hardest battle you'll ever fight isn't against the market. It's against your own impulses. And in the end, that's what it all comes down to, right? Who's really in control here? The whole point of Graham's timeless wisdom is to give you the framework and the tools to make sure the answer to that question is always, without a doubt, you. It allows you to tune out the noise, ignore the madness of the crowd, and truly become an intelligent investor.